Hello, welcome to Pathfinder Wealth Consulting's presentation on the recently passed One Big Beautiful Bill Act. You may have seen us give this presentation live recently in either Wilmington or Cary, but we wanted to also provide a virtual version for those who couldn't attend, or also just for those who want to look back on this as a reference to refresh themselves on this new bill, because there's a lot to unpack here. My name is Davis Bird. I'm a financial planning associate working from the Wilmington office. I've been with Pathfinder for about 5 years now. In that picture there, I probably look a little bit younger than if you've seen me recently, but nonetheless, I look forward to going through this presentation with you and unpacking this new legislation. So what are we going to talk about today? There's really four key things that are themes across all of these slides. So they're not really in order, but they're present throughout because these are really the four things that we wanted to really hone in on with this presentation. The first is looking at the key tax sections of the bill. And those are the sections that are going to most directly affect households and businesses, things like changes to marginal tax brackets, adjustments to tax deductions, and the introduction of some new tax credits. The goal here is to understand not just what the tax bill says on paper, but also what it means for you practically as a taxpayer. Discuss areas requiring further guidance. With most major tax bills and most bills in general, probably, the initial language can be a little confusing and leave room for a lot of questions. So this is no exception to that rule. There are a lot of areas that we're going to be leaning on the IRS and on the U.S. Treasury Department over the next year or so for clarification on exactly how these are going to be implemented into our tax system. Identifying planning opportunities. This is really where the rubber meets the road. Throughout the presentation, we're going to be pointing out and looking for specific strategies that can help you reduce your tax exposure or take advantage of some of these new opportunities that might be available to you. And then lastly, we're going to review the effective dates of these provisions. Some of them are retroactive. They take place impacting prior tax years. Some start next year, some start immediately, and others kind of phase in gradually over multiple years. So understanding the timeline for these provisions is really critical for you to be able to plan proactively and also avoid any unwanted surprises on your tax return. So what is the One Big Beautiful Bill Act? It was signed by President Trump on July 4th of this year. The entire bill is 330 pages of legislative reform, so it's a really sweeping document that kind of broadly impacts all corners of the political world, from healthcare changes, specifically in the Medicare system, to immigration and border enforcement policy, to energy and environmental policy. There's provisions impacting defense spending, student loans, student loan forgiveness programs specifically. But our focus today is really just going to be on tax policy. And with that in mind, I just want a quick refresher. You've probably heard of the Tax Cuts and Jobs Act. We'll refer to it as the TCJA Act. That was the landmark legislation that was passed by Donald Trump in his first term as president in 2017. Most of the provisions took effect in 2018. What we saw with that is a lot of those provisions were set to expire at the end of this year. So these past few years, there's been some looming uncertainty about what will the tax policy be going forwards. Will these still be in effect, or do we need to plan for some of these tax rates and numbers to revert back to what they were before the TCJA was passed? And we now have some clarity with the One Big Beautiful Bill Act, because a key theme of it is that it makes a lot of the provisions of the TCJA Act permanent. And when I say permanent, it means that they don't have a specific sunset like they did originally in the TCJA Act. Inevitably, there will be some new tax legislation passed that is going to change some of these provisions, but for the time being, a lot of these provisions are now set to the status quo. And then kind of the second theme that we see beyond that is the introduction of several new and enhanced tax breaks, which we'll be sure to discuss. One question that a lot of people have had is, what are we going to call this thing? If you look at the actual text at the top, the formal title is An Act to Provide for Reconciliation Pursuant to Title II of House Concurrent Resolution 14. I'm not sure who wants to put that in a newspaper or article? So I guess they decided to rename it and call it the One Big Beautiful Bill Act. That sounds a little more rosy, but it's still a lot to fit into one sentence, particularly if you're trying to do a presentation like this. So a lot of people started just referring to it as the OBBBA, but that's still somewhat long-winded. So then it got shortened to just the OB3. And most recently, I heard somebody call it the Oh Boy Better Bring Accountants Act. I really like that one, but for this presentation, we're just going to refer to it as the bill. Before we dive into the contents of the bill, let's first clarify some things that are not in the bill. These 6 items have been kind of floated around, and there's been some whispers about changes to them. Maybe you've seen them on social media, but we want to be clear that none of these areas have been directed impactfully by this bill. That includes changes to the Social Security program. There have been no material changes on that front. HSA accounts or health savings accounts. In the House version of this bill, there was some language that would have expanded eligibility to who can open these accounts and how much can you contribute in a given year. Once the bill got through to the Senate, they decided to scratch that, and so ultimately those changes are not in the final bill. Restrictions to state-level pass-through entity taxes. If you're not familiar with what that is, that's okay. We'll touch on that later. Capital gains tax hikes. There's been a lot of talk about that over the last few years, but nothing in this bill about it. And then Roth conversions as well. Those still remained a viable and allowable strategy for a lot of different planning purposes. And finally, wealth tax or net worth tax proposals are kind of a alternative, non-traditional way that the government could be looking to generate revenue in the future, but nothing about it in this bill. The first thing we'll talk about is individual tax rates. The tax rates that you see on the right column, far right column, are the current tax rates that we have, which were introduced under the Tax Cuts and Jobs Act in 2018. They were set to expire at the end of this year. However, the One Big Beautiful Bill made those tax rates permanent. So what you see on the far right is kind of what we've had for the past 6 years or so, 7 years, and this bill makes those rates permanent going forward. There is one minor change to the 10 and 12% marginal brackets. Essentially, they benefited from an extra inflation adjustment, which will take effect starting in 2026, and we'll see that on the next slide here. So this slide shows the income ranges of what levels of income fall within the tax brackets that we saw on the last slide. And if you look at those 10 and 12% brackets, they essentially got an extra bump up for inflation by pushing the index year back 1 year. So instead of starting the inflation indexing in 2017, they decided to start it in 2016 for the 10 and 12% bracket, which essentially means a larger amount of income is going to fall in these two brackets, which is a small win for lower to middle income earning households because it means more of their dollars are going to be taxed at this smaller rate. But other than that, no changes to really what we've come to know as the status quo over the past few years. These tax brackets are now permanently in place going forwards. The standard deduction. You might remember the Tax Cuts and Jobs Act doubled the standard deduction, which was a pretty significant change. It went from $6,000 if you're a single filer to $12,000. And if you file jointly, it went from $12,000 to $24,000. That increase has now been made permanent. In addition to that, personal exemptions have been eliminated. Those applied to certain taxpayers up to $4,000 in personal exemptions that you could take against your taxable income. The TCJA Act initially eliminated those, and now they've been permanently suspended. So we see a greater deduction in the standard deduction, but for the people who took this personal exemption, they're going to have some offset of that benefit because they could be losing up to $4,000 in deductions. But the big theme here is that the higher standard deduction is here to stay. The temporary senior deduction. This is one that a lot of folks have asked us about, and there's been a little confusion around this because some people have taken it to be a change in our Social Security system. Like I mentioned earlier, this is not, nothing in this bill impacts our Social Security system as we know it. I can understand why some people would think that because this deduction kind of applies to the same age group that we typically think of as the beneficiaries of our Social Security system, but this is a completely separate thing. And what it is an additional $6,000 deduction per individual age 65 and over. Again, that's per individual. So if you file jointly and your spouse is also over age 65, as a household, you can have $12,000 in additional deductions as a result of this provision. I do want to mention that it is not indexed for inflation, so we're not going to see those figures creep up over time. It's going to be a flat either $6,000 or $12,000 in 2025 through 2028 is when this provision is available. So it is set to sunset after 2028. It's not a permanent provision. Also, I should mention that it is subject to some income limitations. If you file single and your modified adjusted gross income, which we refer to as MAGI, is greater than $75,000, you are going to have a reduction in your maximum available deduction for this provision. And if you file jointly, that limit is $150,000. And the phase out rate for that is 6%. So what that means is for every dollar over that threshold that you earn, 6 cents is going to be reducted from your maximum allowable deduction of $6,000. And we kind of see an example of how this phase out threshold works on this slide. We've got two filers, both are single, both are age 67, so they're older than 65 and thus eligible for this new temporary senior deduction. However, on the left, our friend makes $70,000, which is below the phase out threshold of $75,000. So you can see he benefits from the full $6,000 deduction. Whereas on the right, they make $100,000, which is $25,000 over the allowable limit for the full $6,000 deduction. So you take 6% of $25,000, which is how much their income exceeds the threshold, and that gives you $1,500. So instead of taking the full $6,000 deduction, theirs is reduced by $1,500, and you can see the impact on the total standard deduction at the bottom there. Here's another example of the same thing. I just wanted to show it for a joint tax filer as well. Again, both of these couples are age 67, so they are eligible for this new deduction of $12,000 since both of them are over age 65. Our friend on the left makes $140,000, which is within that phase out range of $150,000. Whereas on the right, the couple makes $200,000, which is $50,000 above the allowable limit for the full $12,000 deduction. So you take 6% of that $50,000, and that's $3,000. So instead of the $12,000 full deduction, they can only take $9,000 as their benefit from the temporary senior deduction. And you can also see that the base standard deduction for both of these couples is the same. That's not going to change. It's not subject to any income limitations. And same thing with the age-based deduction, which is a long-standing deduction that we've had, kind of similar to the temporary senior deduction, but they are completely separate tax benefits. And I know I just threw a lot of numbers at you, so we'll take a quick break for hopefully some comedic relief. This is a quote from the late comedian Art Butchwald that we like to use around the office every now and then. And he says, tax reform is when you take taxes off of things that have been taxed already and you put taxes on things that haven't been taxed before. And what better way to illustrate this than with a clip from the Three Stooges?
Speaking of money, how about the $20 you owe me?
Oh, yeah? Well, I only got 10, so here's 10 and I owe you 10.
Thanks.
Hey, Mo, you owe me 20.
Well, here's 10 and I'll owe you 10.
You owe me 20.
Here's 10, I owe you 10.
Here's the 10 I owe you.
Here's the 10 I owe you.
Here's the 10 I owe you.
Good, now we're all even.
I love that clip. I hope you enjoyed it. I send that around to my friends a lot, and they probably don't find it nearly as funny as I think it is, but hopefully you liked it. And the reason we show it is just to illustrate that this bill is not really any kind of wholesale reinvention or overhaul of our tax system as we know it. It's really just about reallocating where the tax burden falls, shifting certain dollars, and fine-tuning existing rules. And kind of on that note, one area where we're seeing tax benefits being removed is with the repeal of clean energy credits. And this is really one of the only areas in the bill where we're seeing a change that will really increase the revenue that the government is receiving from taxes. And in this case, they're doing that by removing a credit. And again, that's for clean energy credits. These were initially introduced under the Biden administration with the Inflation Reduction Act in 2022. And the purpose of these was to incentivize consumers to go green. So it provided tax credits for home EV charging equipment purchases, for energy efficient upgrades to your home, like windows, doors, installations, HVAC, installation of energy efficient systems like solar, wind, geothermal, fuel cell power, and also for the purchase of electric vehicles. So I will note that these credits were never intended to be permanent. With the Inflation Reduction Act, they were scheduled to sunset and kind of phase out in between 2032 and 2035. So with the repeal of these, it's really just pushing that timeline forward pretty drastically, however, because in January 2026, we see the repeal of charging equipment, home improvements, and clean energy systems. And then probably the most notable one is the repeal of the credit for purchases of EVs. That is still a $7,500 credit for a new EV and a $4,000 credit for a used EV. That will go away in July of 2026. So if you're considering purchasing an electric vehicle or making any of the various home energy improvements listed above, it's important to complete those purchases and wrap up those projects before these deadlines take effect so that you remain eligible to receive these credits and take advantage of them while they're there. One of the most significant provisions of the Tax Cuts and Jobs Act was that it doubled the lifetime gift and estate tax exemption. And if you're not sure exactly what that is, it's the total value of assets that an individual can transfer at their death free from federal estate tax. And before the TCJA Act, it was $5.6 million. And then it was doubled by the TCJA to $11.2 million per person. Since then, just through inflation adjustments, that 11.2 has grown to 13.99 million, which is where the estate tax exemption stood prior to the bill. It's also very noteworthy that this doubling of the exemption was scheduled to revert back to 6.99 million at the end of this year. So it was going to be slashed by 50%, just like it was initially doubled. But again, we're seeing that this bill makes that exemption permanent. So the bill permanently sets the exemption to $15 million per person. And that's actually a slight increase. It's not just making it permanent, it's actually increasing a little bit and then making it permanent. And I want to point out that this exemption is per person. So that means a couple with up to nearly $30 million in assets can pass away and transfer those assets tax-free at a federal level to their heirs. One of the lesser known impacts of the Tax Cuts and Jobs Act was that it greatly reduced the number of households subject to AMT, which is the Alternative Minimum Tax. And what that is a separate federal income tax system that's designed to really just make sure high income households are paying their fair share. So when you calculate for AMT, it includes far fewer deductions, credits, and exemptions than our regular tax system does. And really what you do with AMT is you run your regular tax calculation, the Form 1040 that you've probably seen 100 times. And then you're also supposed to run an AMT tax calculation. You compare those side by side, and if your tax owed under the AMT calculation exceeds the tax that you owe under our regular tax system, you must pay the higher alternative minimum tax amount. Now, what does that have to do with this bill? Well, the changes to the AMT system and the Tax Cuts and Jobs Act greatly reduced the number of households that were paying this AMT. Prior to the act, it was about 5 million per year, and then it was reduced to about 200,000 per year. And the reason that happened was because the TCJA doubled the AMT standard exemption. You can think of that kind of as the functional equivalent of the standard deduction in our regular tax system. In addition to that, it dramatically increased the income levels at which the AMT exemption phases out. So unlike a regular tax system, there is an income limitation to essentially their version of the standard deduction. The TCJA Act increased that level so that the income that you have to earn before you start losing that exemption is much higher than it was prior. The bill makes those changes permanent, with the caveat of it increases the rate at which the AMT exemption phases out from 25% to 50%. So essentially, the bill's changes makes it take more income before you lose the benefit of the AMT standard exemption. But once you reach that level of income, the benefit starts to phase out twice as fast as it would have prior. And the end result of that is we are expecting to see a moderate increase in AMT exposure for high-income households. The state and local tax deduction, otherwise known as the SALT deduction. So this allows individuals who itemize their deductions to essentially deduct the amount of state and local tax that they pay over the course of the year, so they don't have to also pay tax on that at a federal level. Prior to the TCJA Act, this deduction was unlimited, so you could deduct all of the tax that you paid to your state and your municipality. The TCJA Act set a $10,000 flat cap on the amount of deductible SALT taxes. This was particularly relevant to people in high income tax states like California, Illinois, New Jersey, New York, because many of those people pay, some of them far more than $10,000 a year in state taxes, yet now they can only deduct 10,000 of them at a federal level. So what did the One Big Beautiful Bill Act do? Once again, it made that $10,000 cap permanent, but only starting in the year 2030. Until then, it actually increased the amount of SALT taxes you can deduct to $40,000. And that is also subject to income limitations. If you earn more than $500,000 in a year, you're going to see that phase down at a rate of 30%. The good news is it won't phase down to zero. The minimum that it can phase down to is $10,000. So regardless of your income level, you're going to be eligible for at least a $10,000 SALT deduction, assuming you pay that much in SALT tax, with a potential maximum of $40,000 that's deductible over the next 4 years from 2025 to 2029. 5 years, excuse me. Pass-through entity taxes. This is one that kind of provides a loophole for those who maybe would like to deduct more than $10,000 in their state and local tax deductions. In order to take advantage, I guess, of this loophole, you need to be an owner of a pass-through entity business, which includes a sole proprietorship, a partnership, LLCs, S-corps. So this is a big planning opportunity for business owners of these types of businesses. And what it does is it allows these owners to elect to pay their SALT at a business level rather than having it flow through to their individual return. And what that means is essentially SALT becomes a business expense that's fully deductible and not subject to limitations. The end result of that is that the state still collects the same amount of tax revenue, but the SALT deduction at a federal level is bypassed and there's nothing paid at the individual level. Now, in order to take advantage of this, your state does have to allow for the election for you to kind of take that SALT as a business expense. Good news is 36 states currently allow for this, and North Carolina is one of them. You may recall we mentioned this at the beginning of the presentation as an area that was not affected by the bill, and that's because a lot of people were kind of looking for the federal government to close this loophole with this bill that Everything that we've read so far suggests that is not the case. There's nothing in the bill to suggest that you cannot continue to take advantage of this loophole if you are a business owner. So we're still kind of waiting for the possibility that the IRS issues some further guidance, kind of closing that off. But up till this point, it's still a viable strategy if you are an owner in a pass-through entity. Charitable contribution deductions. Generally speaking, to receive a deduction for your charitable gifting, you need to be itemizing your deduction. There was formerly, I think it was a $600 deduction for those who took the standard deduction of charitable contributions. This bill allows for a $1,000 charitable contribution deduction for those who take the standard. And if you file jointly, that's a $2,000 deduction. So what we're seeing is kind of a little bit more of an incentive for people on the standard deduction to gift charitably. On the flip side, for people who itemize their deductions, and this is kind of a key one, the bill imposes a floor of 0.5% of income that you need to gift before you can start taking tax deductions for your charitable gifting. So that means if you are if your magi is $100,000, you're going to need to gift $500 or $501 before you can take any charitable deductions. That first $500 is no longer going to be deductible. And this does lead us into a few key planning opportunities to work around the introduction of this provision, because I do want to note that it starts in 2026. So this is not going to be a hurdle in 2025 if you itemize and gift charitably. So one way to kind of address that and get around this floor, at least for the 2026 year, the first year that it takes effect, is to utilize a donor advised fund. If you're not sure what that is, I like to think of it as the everyday person's private foundation. They're easy to set up, they're inexpensive, they don't have maintenance costs. It's a great strategy if you have kind of an anomaly high income year and you're charitably inclined in the first place. This is a great way to kind of front load some of your charitable gifting and get a large tax deduction in one year, and then kind of spread out those gifts to the actual charities over a few years. And I may have gotten a little ahead of myself here. If we look at the graphic down below, this kind of shows how these accounts work. So you as the donor will make a donation to the fund. For whatever amount you put into the fund, you then receive a tax deduction for that amount. Now, once the money's in there, you can invest it pretty much just like you would invest any other account, which gives your kind of charitable base of funds that you intend to gift an opportunity to grow even larger than you intended. And then from there, you can advise how to distribute those funds out to qualified charitable organizations. The cool thing about donor advised funds is you don't receive the tax deduction once the money goes out to the charity. You receive the deduction once you put the money into the fund. So if you wanted to, you could put the money in today, take the tax deduction in 2025, but you don't actually have to give it out until whenever you decide. You could wait 10 years to let it grow if you wanted to. So a good way to kind of skirt that 0.5% AGI floor is to open a donor advised fund and front load your planned 2026 gifting into that account this year. And then you're able to take the full deduction in 2025 and not have to worry about the imposition of that 0.5% floor in 2026. A second way you can get around this is through the use of qualified charitable distributions. You may hear us refer to those as QCDs. They are available to owners of IRA accounts who are age 70 and a half or older. And what it is a direct transfer of funds from your IRA to a qualified charity. You can see in that graphic below, you as the donor would instruct your IRA custodian to send funds out of your IRA directly to a charity. And you can see with that kind of dotted arrow line there, it's just kind of skipping the IRS in general. And that's the key benefit of a QCD. From a tax perspective, the amount that you send to the charity is excluded from your taxable income. So it's going to be an above the line deduction that reduces your adjusted gross income, which can also help towards if you're concerned about hitting some of those thresholds like the net investment income tax or increasing your Medicare premiums, this is a great way to do that. Again, if in the first place you were already charitably inclined. Any funds sent out via qualified charitable distribution count towards your required minimum distribution if you are of age to have one. So that's when you have to start taking money out of your IRA each year. Some people don't really need that income, and they'd rather not have to take it out because it just increases their taxable income and they don't necessarily need the funds. So one option to reduce the tax impact of that would be to utilize QCDs, and then it's excluded from your taxable income. I also want to point out that no actual tax deduction is claimed when you utilize QCDs. The benefit that you're getting is the exclusion of those funds from your income in general. So since they're never reported as taxable income, there's really nothing to deduct. So some people will be a little bit confused, like, why didn't I get a deduction for my QCDs? And that's because you don't need a deduction because they're not taxable income in the first place. And then going back to how that relates to this bill, qualified charitable distributions are not subject to that 0.5% AGI floor. Mortgage interest deductibility. So the bill makes home interest or mortgage interest up to $750,000 of a qualifying loan balance tax deductible. Home equity line of credit, HELOC interest, was made permanently non-deductible unless you're drawing from your HELOC specifically for the purpose of making home improvements, otherwise known as acquisition debt. So really what they're saying here is you can't take out a HELOC, draw from it, go to Walmart, and then get a tax deduction on the interest that you owe from drawing on the HELOC. Now, one kind of interesting question is, how is the IRS going to take the time to enforce this rule? Are they really capable of knowing exactly your reason for drawing from your HELOC? I don't have the answer to that question. Our tax system is really one that's based on honesty and trust. And so this is one where that comes into play. And then the final one is mortgage insurance deductibility. So mortgage insurance premiums starting in 2026 become deductible. So those are for folks who buy a house but don't put 20% down. They have to pay PMI premiums each month until they build up to 20% home equity, and those are now tax deductible. So this is a small win for first-time homeowners and maybe middle-class home buyers, just kind of easing the cost of ownership marginally for those folks. The miscellaneous expense deduction, I won't spend too much time on this, but this was an itemized line deduction that has been done away with under the bill. And it was initially done away with under the TCJA Act, so this has not been available since the 2017 tax year. But one thing that it did allow you to do is deduct your financial advisory and tax preparation fees. So unfortunately, you cannot deduct the fees that you pay to your wealth advisor, and I assume for most of you listening, that's probably us. Unfortunately, those fees are not tax deductible going forwards. What I will say is that the CFP board, the Certified Financial Planner Board, did spend a decent amount of time and effort lobbying Congress to try and get them to reinstate this deduction, but ultimately they were unsuccessful. And then also there has been a new itemized line item introduced for teachers, which allows them to deduct their educator expenses starting next year. Now, some folks have questioned this because typically those who itemize are relatively higher income earners. And as we know, our teachers don't get paid nearly enough. And so people have raised the question of, well, I doubt many teachers itemize their deductions in the first place. So the introduction of this new deduction seems a little bit pointless if not many teachers are itemizing their deductions. And there is certainly some truth to that statement. I fully understand that. I'm sure there are some scenarios out there, though, where they're maybe married in a dual income household and they have a good reason to itemize, and those teachers will be able to take advantage of this new deduction. There is also an above the line deduction for educator expenses that teachers can benefit from. It's a small $300, but that is not going away either. So that is in this new deduction is in addition to the existing $300 above the line educator expense deduction. The qualified business income deduction, otherwise known as the QBI, was introduced under the TCJA Act and made permanent under this bill once again. And what it does is allow many business owners to deduct up to 20% of their qualified business income. This again is subject to some income limitations, which you can see on the middle of the screen there. And notably for businesses that fall in the category of specified service trade or business, and this includes law offices, consulting firms, financial advising firms, tax accountants, that deduction, depending on the qualified business income of the individual, or excuse me, depending on the taxable income of the individual, that qualified business income deduction can be phased all the way down to zero. Whereas for businesses that fall outside of the specified service trade or business categorization, the floor is not zero. It can only be reduced to what's known as the wage and depreciable property limit, which typically is just 50% of the business's W-2 wages. The no tax on tips provision is a fun one that's gained a decent amount of headline space recently. And that starts this year through the 2028 tax year. And what it does is it allows individuals or households to deduct up to $25,000 of qualified tip income in a year. Now, this is still subject to payroll taxes, so that's your Social Security and Medicare taxes. And it also has no impact on state income tax laws. So despite the name of the bill, no tax on tips, you still may pay state income tax, likely will, depending on the state you live in. But at a federal level, $25,000 is deductible. Now, what is a qualified tip? The bill specifies that these are tips earned in occupations that traditionally and customarily receive tips. So they put that language in there to prevent businesses like consultants, financial advisors, attorneys, CPAs, that kind of thing, from just saying, oh, we decided, or our clients decided to tip us, so now we can get a nice little tax deduction that we couldn't before. No, you have to be a business that historically its employees have relied on tip income as part of their total wages. Obviously, these tips must be voluntary and at the sole discretion of the person who paid them, so you can't be incentivizing people to give tips to your employees that can then be tax deductible. They have to be earned through a non-SSTB. Remember, we talked about that specified service trade or business last slide. Those businesses that fall in the camp of an SSTB are not eligible for this deduction at all. And again, that's lawyers, doctors, accountants, certain types of advisors. And notably, it also includes musicians, artists, and entertainers, which that's kind of a camp where you probably think they're dependent on tip income to some extent for their living. But unfortunately, they are classified as an SSTB and thus do not qualify for this deduction. So limitations around the tax on tips provision, or the no tax on tips provision. It's the same deduction limit for single and joint filers. Typically we see, for example, if it was $25,000 for a single filer, it'd be $50,000 for a joint filer. That's not the case. Regardless of your filing status, it's a $25,000 household allowable deduction. You see the income limitations there. The taxpayer must have a valid Social Security number by the tax filing date. That's another thing that we've seen kind of as a theme across this bill, is they want to make sure that people benefiting from this deduction have a Social Security number. And you might think, well, duh, they're filing a tax return. There are ways to file a tax return without a Social Security number. The most common one is filing using an ITIN number, ITIN. It's just kind of like an alternative identification number. But that is not going to do for this provision and many others in the bill. You have to have a valid Social Security number by the tax filing date to benefit. And then for business owners, the amount of the deduction is limited to the business's net income. And they only do that because they don't want you to be able to take this deduction and then create a loss for your business on the year. That wouldn't be right. And then also any tip deduction also reduces the qualified business income for that business owner dollar for dollar. And that just prevents them from kind of double dipping, taking that QBI deduction in addition to the tax on tips deduction. That wouldn't be fair. Similarly, we have the no tax on overtime provision starting this year through 2028. So it's good for kind of the same timeline, and it allows a deduction for qualified overtime pay of up to $12,500 or $25,000 if you are married filing jointly. This is also subject to income limitations you see there in the second bullet, and it applies only to the portion of pay above the employee's regular hourly wage. So for example, if you earn $20 an hour and your overtime rate is $30 an hour, you can't work 1 hour of overtime and then deduct $30. No, you can only deduct the difference between your overtime pay and your regular base pay. In this case, it would be $10 of deductible overtime pay per hour worked, not the full $30. And then to qualify for this, the bill specifies that the overtime pay must be separately stated on the employee's W-2. So this is actually going to require an adjustment to the standard W-2 form as we know it, which most likely is not going to be able to happen for this tax filing year. So what we're assuming, but again, an area we need guidance on, is there some sort of supplemental statement or document that we need to send in, or that businesses who have employees with overtime need to send in along with their W-2s so that they can report this qualified overtime pay. The deduction of interest on auto loans is another one that's been introduced under this bill, and this is only for new vehicles that are assembled in the United States. Now, how do you know if your car was assembled in the United States? The reality is most likely it was assembled, or at least had help from countries all over the world to source different parts for this car. However, they classify the final assembly of where the vehicle, like the finishing touches were made, is what determines where the vehicle was assembled. And you can verify that using your VIN, vehicle identification number. It will specify where the final assembly for the car was. So you can only utilize this deduction if on your VIN number, the United States is where the place of final assembly was. This only applies to car loans incurred or refinanced after 2024. And again, there is a phase out that you see there in kind of the second row. Trump accounts. This is one that has had a lot of headline space, and also one that I don't think many people saw coming. Didn't seem to be too much speculation about these Trump accounts until the bill was passed and we were reading about it as legislation. So, and it's certainly an area where there's kind of the most confusion or unknown about out of probably anything else in this bill, at least from a tax planning perspective. So this is an entirely new retirement account that's been introduced into kind of our system, and it's been dubbed a Trump account. It is IRA or IRA-like, but there are some key differences between a Trump account and a IRA or a Roth IRA. These accounts are specifically designed for children under the age of 18. So it's kind of a way to help jumpstart retirement savings at a young age, which we know is so important, getting started early. So the contributions into these accounts grow tax deferred, but they are not tax deductible. So that's one of the key differences between an IRA and a Trump account that we know so far, is that the contributions, you do not get a tax deduction for them, but they do benefit from tax deferred growth. Also, there is no earned income requirement to contribute. So kind of a hurdle that we've seen. A lot of parents would love to start a Roth IRA for their kid at a young age and let that grow. But a Roth IRA requires that the child have earned income in order to fund that account. That is not the case with Trump accounts. There's no earned income, and parents can contribute on behalf of their child regardless of income levels. Some key dates for these Trump accounts is January 1st of 2026 is when you can start opening accounts. July 1st of 2026 is when you can start making contributions to these accounts. And what do we know about these contributions? There is going to be an aggregate annual contribution limit of $5,000 that will be indexed for inflation, so it'll slowly creep up over time. Contributions made into this account by an individual on behalf of the child do not count towards the IRA contribution limit. So it's not going to go against that amount. You can still fully fund an IRA if you're eligible and also contribute towards a Trump account. So who can contribute to these? Family and friends. Again, any contributions made by family or friends would count towards that $5,000 aggregate limit. And again, they are not tax deductible. The bill specifies that employers can contribute to these accounts as well, up to $2,500 per year, which also counts towards that aggregate $5,000 limit. Notably, any contributions made by an employer to a Trump account, presumably on behalf of one of their employees' children, does not count as income for the employee, so it's excluded from their taxable income. Governments and nonprofits can also make contributions to these accounts. Notably, there is no stated limit in the bill for how much they can contribute, and it also specifies that any contributions from a government or a nonprofit does not count towards that $5,000 aggregate limit. Now, this is one that we will need and hopefully will receive clarification on, because kind of as it reads, has raised some eyebrows from folks about potentially opening up a loophole for sort of ultra high net worth families or ultra high income households. It's not uncommon for us to see ultra high earners open up a charity or a nonprofit. And people have kind of raised the question of, wait a minute, the way that this reads, no stated contribution limit from a nonprofit, it seems like potentially an avenue for just funneling money into one of these Trump accounts through a nonprofit for one of their children. I can't speak to the validity of that statement, but I think it's a point worth exploring, and why I say hopefully we receive some clarification around this. Now, there is this pilot program credit to kind of introduce these Trump accounts as a new retirement savings vehicle. And for children born in 2025 through 2028, the parents can elect for their kid's Trump account to be funded by the government with a $1,000 credit. Children born before 2025 are still eligible to open a Trump account. Unfortunately, they just aren't eligible for this $1,000 initial seeding credit from the government. This raises some other things requiring clarification. Exactly how will that $1,000 get into the child's Trump account? Will the Treasury automatically open these accounts for eligible children? How do the parents know how to make the election? And also, we know that contributions into these accounts can't start until 2026, July 2026. So how will children born in 2025 be handled, and how will they get their $1,000 credit if money can't even go into these things until July of next year? There's also some investment rules around what kind of investments can be owned in these accounts. The bill specifies that investments must be U.S. equity index funds, so think of mutual funds or ETFs. It does allow for market cap weighted indexes. Think of that as like the mid cap growth fund, for example. That's allowed. Sector specific funds or index funds are not permitted. So that would be something like your healthcare ETF, your financials ETF, things like that are not permitted. Also, funds in Trump accounts are not allowed to use leverage, so they can't invest with borrowed money to try and amplify their returns. And also expense ratios of funds in these Trump accounts are capped at 0.10%. So taking kind of these three restrictions together, what we can see is that the investment choices are intentionally simple, they're low cost, and they're restricted to kind of broad-based U.S. stock indexes. So they're designed to promote long-term, low-fee growth without speculative risk. The distribution rules for these accounts, in many ways, they kind of mimic the distribution rules for IRAs. There are going to be no withdrawals permitted from these accounts before age 18 of the child beneficiary. Once they turn 18, withdrawals are permitted for qualified purposes, such as higher education expenses, up to $10,000 in withdrawals for first-time home purchases, and business startup costs. So they're kind of trying to encourage entrepreneurship with these accounts as well. Withdrawals for those purposes after age 18 will be taxed at ordinary income rates. Withdrawals for any other purpose after age 18 and before age 59 and a half are taxed just like an early IRA withdrawal. So you get hit with your ordinary income tax rate plus a 10% penalty on non-qualified withdrawals before age 59 and a half. After you turn age 59 and a half, just like an IRA, distributions are permitted for any purpose. They're taxed at your ordinary income rate. We are not sure with these accounts if RMDs will be required. That's another area that we need guidance on. Depending on who you ask, this is kind of an exciting introduction and a change up within what we traditionally think of as our retirement accounts, but there are a lot of question marks around these, and I could see the implementation of them at first, at least, being pretty sloppy and all over the board, at least with what we know now. That concludes the presentation on the One Big Beautiful Bill Act. If you have any questions, please do not hesitate to reach out to us. You can email us or give us a call at the main line, either in the Wilmington or the Cary office, and we would be more than happy to talk more about what we know about anything that's in this bill, or maybe if you want to talk specifically about how it might apply to your situation, please reach out. We're always happy to talk with you, hear from you, and figure out how we can help you leverage this new bill to hopefully your benefit. So yeah, thank you for your time and have a good day.